Welcome to the Liquidity Event, a show about all things personal finance with a laser focus on taxes, financial independence, and equity compensation. Hosted by AJ and Shane of Brooklyn FI, each episode will focus on a personal finance topic, some driven by news headlines and sometimes driven by listener questions. And sometimes you'll just get two money nerds rambling about what they think is interesting. Just a quick note before we get started, this podcast is for informational purposes only and should not be considered tax or investment advice.
Hello, and welcome to the Liquidity Event. We're your hosts, AJ.
And John, filling in for Shane this week.
And this is episode 121, being recorded on October 1st. Happy October. Airing later this week on Friday, October 4th. A quick reminder for all of you listeners, we will answer your questions live on the podcast if you leave us a message. You can do that at memo.fm/the liquidity event. How you doing today, John?
I'm holding up all right. It's a new quarter. It's the fourth quarter of the year. It's October.
Happy Q4, everyone.
Where did everything go? Where did the year go?
I don't know. I think it's
flown by,
scratching its way down my throat because I feel under the weather. John.
I was going to say, how are you holding up, AJ?
100% today. I am ready to talk about the Q3 economic results with you.
Yeah.
Cannot wait. I have not been sleeping well. I am running on very little sleep, and I used to be the kind of girly who could, pull an all-nighter, write the paper, chug 6 glasses of coffee, go to a yoga class, and I am not that girl anymore.
You don't rally the way you used to? Is that what you're trying to say here?
No, I do not. I can function on 6 hours. 6 hours, and I'm like pretty good to go. Less than that, multiple times in a 7-day period, very bad for me.
Not good.
No good.
Hate to see it. I'm glad you were at least in better shape last week when we were doing our rent versus buy webinar, which was, we had a ton of people show up for that. That was so much fun.
Always fun. Yeah, and we did that crazy thing where we gave away $200 in Amazon gift cards.
As an impact on people showing up, perhaps.
Which was great. So someone won $200 to spend on whatever they want on Amazon.
Yeah.
Okay, quick question for you, John. If you had $200 right now to spend on Amazon.com, what would you buy?
$200 to spend on Amazon.
You have 3 seconds to answer.
Oh my God. Probably something for my trip coming up next week. I'm going to Utah, do some national parks. Yeah. What about you?
Laundry detergent.
$200 worth of laundry detergent? Are you insane?
I feel like I always run out of laundry detergent, and living in Brooklyn, it's really annoying to get laundry detergent, and I like a very specific kind of laundry detergent.
Do you use the pods?
That's the whole point. It's like I tried the pods. I hate the pods.
They're so tasty, though.
Ugh. Maybe that's why I'm not sleeping. I'm not eating laundry detergent pods.
Oh my goodness! I'm glad that fad is over with. I'm glad we're not eating.
If you missed that webinar and did not win a $200 Amazon gift card, don't worry. You can go to brooklynfi.com and watch it. And we talked about whether it's better to rent a home or buy a home.
Yeah.
And the answer is obviously different for every person. We're going to talk a little bit about housing today and interest rates. So kind of a recap of that as well. But speaking of recaps, we just ended Q3 of 2024.
Q3.
What a wild quarter that was. What did we have? We had the Olympics in Paris.
Yes.
Huge.
I think we won. I think the United States won again, which
we
is
win
good,
every time.
obviously.
Don't we win every single time? What was your biggest win from the Olympics? I'll go first. Mine was Alana Mayer. She's the rugby player who just took to social media and was just this incredible personality. And now she's on Dancing with the Stars, which I've never seen. But anyway, that was my win. I really like watching her.
The dad from Turkey with the cats, the divorced dad from Turkey with the cats, who was in the pistol competition.
That was sick.
And so my dad is now, my dad's training he wants to be in the pellet competition in Los Angeles. But my father doesn't fly, so I told him at this rate he should probably start driving to LA right now if he's going to go there for
take the train, take Amtrak.
Yeah,
super fun.
Amtrak.
What else do we have?
If he's taking Amtrak to LA from Pennsylvania, he should leave. He should have left yesterday to get there by 2028.
Yeah, flying super convenient, folks. Not great for the environment, apparently. By the way, I just want to shout out a friend of the pod who works at a site called Heat Map. They're a climate news, climate change. They follow the trends. They report on things. They have an awesome guide, which we'll link to in the show notes, about how you can actually do things in your life to impact climate change. So it's we've heard flying is bad, get an electric car, all these things. They actually break it down. They're super smart climate reporters. So we'll check that out. Apparently flying is not that bad if you're flying commercial. Apparently buying an electric vehicle does make a huge difference. And now I feel guilty for not buying an electric vehicle. But anyway, what else happened in Q3? Oh, the strike, the Hollywood strike that actors, directors, everyone was involved in, that kind of came to a resolution at the beginning of Q3. I already forgot about that.
Yeah. We had Biden dropped out of the presidential campaign. Trump got shot. Somebody tried to attack Trump again. That all has happened in the last 3 months, folks. I know that feels like it's been about 1,000 years, but Q3 was, in some respects, flew by. And in other respects, I was like, holy crap, that was only 3 months ago that all these things happened. Less than 3 months ago.
And really, at the end of the quarter, we had a big, let's call it a big economic event, which is that we had a rate cut, an interest rate cut by the Fed.
Exactly.
Q4, I don't think there's that much going on. I think it's going to be a fairly quiet quarter.
Yeah, nothing going on.
I think on November.
Maybe
first
in New York.
Tuesday in November.
Maybe in New York City or Palm Springs, AJ, where you don't get the same amount of political ads that I get here in swing state, purple Pennsylvania, about who we're going to vote for. But I literally cannot turn on the television without something. And so for those of you that don't know...
Wait, I'm sorry. You have a television?
I have a TV. A what? What do you call what?
Do you pay for cable?
I use YouTube TV.
Oh, because sports, right? That's why you have to have a TV. Okay, cool.
News, yeah.
Got it. Okay.
Mainly sports. Yes.
Got it.
Anyway, okay. What was that all about? Okay, did you just boomer me right now on the podcast?
I'm always shocked when people have televisions. Actually.
I use YouTube TV. I share it with a few folks though, which makes it cheaper because you can share it with multiple.
You can spend your money on whatever you want.
Anyway.
I'm spending all my money on laundry detergent apparently. So I'm not
AJ
with
like $200 worth of laundry detergent to go along with her Viva paper towels. For those of you who listened a few weeks ago.
Oh my God, Viva paper towels. I'm enjoying my Viva paper towels endlessly.
So,
all right,
here we are.
What are we talking about?
We're in the start of Q4. Let's talk about what happened last quarter. Let's talk about Q3. What went well? What didn't go well? How the market's changed, and the market changed quite a bit. I feel like the whole first half of the year, AJ, was tech. Do I have NVIDIA stock? Why don't I have NVIDIA stock? Yeah. What's my exposure?
Everyone's fired for not telling me to buy NVIDIA stock 5 years ago.
Exactly. Why didn't I get a job at NVIDIA? All those sorts of things. That was the whole first half of the year. The last quarter was this really big rotation. So interestingly enough, tech last quarter only went up about 1% or 2%. Was actually down up until about a week ago on the quarter. So really, all the gains that we saw in the S&P 500 and other parts of the market were in other parts of the market, and it was a good quarter for that. And so things that stood out to me, a couple of things. We saw this big rally in the small cap side of the portfolio. So small cap value stocks up 9-10% on the quarter to move into positive territory on the year, close to about 9%. So that was really nice to see. It's been an underappreciated asset class. And then
I appreciated it.
You appreciate it. Thank you. And then we saw some other parts of the portfolio. Real estate, REITs. Their returns jumped off the page. And so REITs on the year up 13%. They were down 2% coming into the quarter. So they had about a 15% rally last quarter. That was fantastic.
Do you think that was just due completely to the interest rate?
I think interest rate situation certainly helps. I also think that they just got beat up unnecessarily a little bit in the market, and so they were kind of underappreciated there. And then last week, I started writing our quarterly commentary before the quarter's over because I like it when it's fresh, right? Here we are on October 1st.
John always does his homework on time, everyone.
I always do my homework on time. Recovering type A, folks, okay? And here, one of the reasons why I try to do that is because, here we are in Q4. The day has already started off with the market being down slightly, with Iran launching missiles at Israel. Like, the news cycle moves on very quickly. And so I need
invading Lebanon?
Israel invading Lebanon. Yes, exactly. Yeah. So just another boring day here in the geopolitical world we live in. And so I kind of start writing about what's happening while it's happening, because otherwise the world moves on very quickly. And I had to go in and edit the commentary because really the story was REITs have rallied, that sort of thing. They're going to be the second best asset class after large U.S. stocks, which are up about 21% on the year. And then everything changed last week. Emerging markets popped like 7% last week because China announced kind of, throw the kitchen sink at it, stimulus approach to their economy, which has been struggling post-COVID. They're starting to feel the repercussions of the one-child policy. Their demographics are out of whack. And the fact that they are engaging in some stimulative efforts really helped the emerging market piece. And so emerging markets, so think about China, India, parts of South Central America, up over 17% so far this year. into second place in terms of best performing asset class. We're seeing gains outside the United States. Everybody's like, I just want to own the S&P.
Yeah.
I just want that performance. Emerging markets up 17. Other developed international stocks like Europe, Australia, Japan, up about 15%. And so,
just so everyone knows what we're looking at, by the way, off screen, is we are looking at a chart of the past,
about 15 years worth
15
of
years of each asset class, and each asset class is a color. So we get this really nice patchwork quilt because each year there is not one single asset class that performs better than all of them. It's all over the place, right?
Yeah.
Last year, large cap also was fantastic, except in 2012, large cap was somewhere in the middle bottom of best performers, right?
Yeah.
So this is why we diversify our assets, right?
Why we diversify portfolios, exactly.
And, you know, our rent buy discussion last week was very interesting. I think something we probably could have touched on a little bit more is the actual, when you buy real estate, you are concentrating a lot of your net worth in one single asset class. So, you know, a lot of clients will come to us and say, and we're going to touch on this later with a listener question. We'll say, you know, hey, I've got $1 million in my portfolio. This house is a $2 million house. Should I put a bunch of this money down? Should I put a bunch of money into this house? I don't want this big mortgage payment. And our answer is almost no. It's too much concentration risk. We want to be spread out so we can take advantage of the winners each year. We want our portfolio to grow steadily. Of course, yes, if we all bought NVIDIA stock 5 years ago, there are people that did that. And that was really great. And we congratulate them. That was, you know, probably some smart planning and a lot of luck, right?
Yeah.
So we're in a position now, I think, I mean, the stock market feels like it's doing like in the general, like in my like litmus test of like talking to people at weddings and parties, people are like, oh, my 401k is up this year. Yeah. And I go, yes, isn't that great? That's my only response. Like, I don't want to get into this. I don't want to talk about it. I don't want to scare anyone, right? Like, if you're listening to this podcast, we can scare you a little bit. We can talk about the nitty gritty here, but there is a general, like, positive economic outlook right now. Inflation's down a little bit. Interest rates are coming down. The things that actually matter to the average person seem to be going in the right direction.
Yes. And so I agree. I agree. We're seeing some of that. I think there are some kind of warning signs that are starting to go off economically for just kind of where we are in the cycle. We'll talk about that here in a second.
I can't find my soundboard.
Exactly. Where's your soundboard? Did that get lost in one of the moves? You know, just to kind of round out how things did on the quarter, just to kind of finish painting that picture. U.S. bonds did well. They moved into positive territory. So aggregate U.S. bonds up about 4.5%, 5%. Interest rate cuts really impact that. And so, you know, interest rates going down, bond values go up. And so that helped. International bonds, municipal bonds also did well, posted some positive numbers, some gains. And so I don't want that to be missed. The kind of order of magnitude of change in bonds has been higher. The percentages are just lower, given that equities really had a 6-month head start throughout the first part of the year. But I think you bring up a good point, AJ, which is I think
really?
There are people,
that's a first.
Yeah, exactly. Please, everybody, mark this clip. Let's save that. HA brings up a good point where, you know, overall economically, we're in this weird spot. Okay, and we're in a weird spot because if you own assets, if you have a 401k or you have a home, they are likely more valuable today than they have ever been. Okay, and that feels really good, and it's really great for folks for accumulating wealth. If you
go to the polls, folks.
What's that?
Go vote.
Yeah.
You feeling good? Go vote.
Okay, so if you have those things, you feel great. But if you don't have the ability to accumulate assets to save, or if you haven't had the ability to buy a home, then you haven't been able to participate in that and in those gains. And now many of those things, in particular, the stock market is more expensive than it was a few years ago. The housing market is a hell of a lot more expensive than it was a few years ago, and it is now harder to even participate in it. And so, because I struggle this time of year, it's an election year. We're talking about, is the economy in a good place? Is the economy in a bad place? Do we want change? Do we want more of the same? Constant evaluation. It really depends on your situation as to how you're feeling about the economy and where it's at. I think inflation is a very good example. Inflation, economically, I would say the greenest flag economically. I'm going to talk a little bit about the beige flags in the economy here. What? You don't like my analogies?
I like some of your analogies.
Okay, we're going to talk about the beige flag here and say the greenest flag for the economy is that inflation is down.
Yeah,
right?
for sure.
But I think try talking to one of your friends who doesn't have a finance degree about inflation being down. And it's basically saying like, hey, I gained 10 pounds in 2022. I gained 7 pounds in 2023. And I've gained 2 pounds here in 2024. Inflation is down. It means things still get more expensive. They're still getting more expensive. They're just not getting more expensive as quickly as they were.
Right.
And so that's the thing. People say, well, inflation's not coming down. Milk, eggs, bread, whatever is still more expensive than it was. Correct. It's probably not going to get cheaper.
It's not going to go back to 2022, 21 prices.
Correct. Correct. And I think that's the hard part.
Unless a recession happens, right?
Unless we get a recession.
We don't, which is an interesting, like what you're talking about is a class difference, right? If you do not have access or the ability to fund a 401k or purchase a house right now, obviously recession harms you in other ways, but a recession might bring housing prices down. A recession might bring grocery prices down.
But you may also be the most vulnerable to getting laid off and losing your job, right? In that scenario. And so I think, looking at the economy today, right? What do the overall indicators say? I think we were concerned about a recession a lot in 2022 when the market sell-off happened. We saw a lot of layoffs. We kind of dodged a bullet there, and had this kind of soft landing. But part of that is because there was still so much pandemic stimulus floating throughout the economy, right? And people had people's savings rates were in a good spot. Their household debt wasn't in a bad spot. I think what we're seeing now is this kind of slow uptick in delinquencies on auto loans, on credit cards, that sort of thing. We're seeing household debt service ratio to get back to where it was pre-pandemic, sort of a normal level, about 10% of disposable income. We're seeing consumer savings rates and excess savings dwindle and savings go down.
Hate it.
And so these are all things that are kind of saying, hey, the land of milk and honey of growth that we've had, fueled by pandemic spending, fueled by a strong consumer, maybe starting to subside a little bit. That doesn't mean we're going to go into a recession. It just means that we can't probably tie ourselves to 2+% growth here looking ahead on an ongoing basis, perhaps.
Right, exactly. Except we have various smart people at respected institutions about every quarter say the same thing, right? Which is that indicators say we're probably heading into a recession. And we haven't, right? Yeah. By the definition of recession, we are not in a recession. We have not been in one.
We've not been in one. We haven't had 2 quarters of declining economic growth and an overall economic slowdown. We thought there was a chance of one in 2022. We ended up not having that. But I do think, one of the reasons why we saw a big Fed cut 2 weeks ago now is because in large part because of the labor market. And what we heard just from employers all over the country a couple of years ago was we can't find people. We have more. There's more openings than there are people looking for jobs. We saw wage inflation because of that, which is good for the American worker, right? They're making more money. Now job openings are down. The unemployment rate's a little bit above 4%, which is where it should be, around 4%. It's about 4.2% right now. And so we're just not seeing that same market. AJ, you and I were hiring recently. We're bringing on a new person here. We had an overwhelming amount of interest. I literally had to take the job posting down.
After 3 days or a weekend.
Over a weekend had nearly 200 applicants for this role. Now, I like to think it's because we're Brooklyn FI and everybody just wants to work here, but it does kind of say something about the labor market today.
The indicator, yes.
Yeah, it's a bit of
our tiny sample size indicator.
Exactly. And so we're not seeing a big uptick in layoffs.
Isn't that funny? It's like, yes, sure, we're looking at these big data sets, but at the end of the day, these are just indicators based on survey responses, or even things like CPI is still a survey. These numbers are still based on reported things. And when we're talking about the economy and when we're talking about really financial planning in general, one thing we say something on the podcast, someone's going to hear it and be like, oh, this really impacts me. Or why are you guys talking about this? Doesn't impact me. I would never be able to contribute to my 401k. Or oh my God, you guys are still talking about 401ks. I've got $10 million of stock I need to sell off this year. What's going on? So I don't know. I agree with your sentiment that it's a good time to be wealthy in America.
Yeah. I mean, it's hard to find a bad time when it is to be wealthy in America, given the way the system's set up. But that's a different story. Have
y'all heard of a little thing called capitalism?
Jeez. But, I do think that there are some indicators that the overall economy, the labor market's softening a little bit. And so we just need to be mindful of that. That doesn't mean it won't come back. It doesn't mean that it's not, it's just uncharacteristically tight. and very challenging to hire a few years ago. It is not as much that. And then I think we are getting a little bit of pseudo stimulus from the Fed in essence with rates coming down. And I think mortgage rates in particular, AJ, was just something we talked about a lot last week on the rent versus buy. Now just hovering about just over 6% nationally, which surprisingly feels good by recent. But yeah, it's, we're hearing a little bit about the refi question as well. I think we have different opinions on that though. So go ahead.
Yeah. I mean, on the refi question, my opinion is that, so I have the opportunity to refinance my mortgage. Now I'd save, the interest rate would come down by about 2 percentage points.
Yeah.
That's pretty significant.
Yeah.
For me, that's not significant enough. I'm going to wait another year or quarter. I also have to wait till this year closes to file my tax return to actually show the bank that I make money. Yeah. What I was going to say is, speaking of we're kind of like in this waiting period, this holding pattern, right? We have this U.S. presidential election coming up in a month. Jesus Christ.
Yeah, about 4.5 weeks, 5 weeks.
Oh I'm just had a heart attack. So we're running out of time here. I feel like everyone's holding their breath. We don't know what the outcome of this race is going to be. Yeah. We're afraid to make decisions. Companies are afraid to go public, which we've seen for the past, 2.5 years at this point. We had this huge surge of IPOs in 2020, 2021, 2022 was disaster, 2023 not much better. But we actually did have a company, an AI chip maker, file their S1, which is their indicator that they are exploring and they're ready to show their financials to the analysts. They're ready to go public. A company called Cerebras, speaking of NVIDIA, they are coming for NVIDIA's lunch. The CEO, when asked in a press conference of how much market share they thought they could get away from NVIDIA, he was like, all of it. What do you mean? Enough to make them scared. I love that energy. Coming out with big chip energy. So their whole thing is that they make bigger chips. So they make bigger, faster chips that can process can support AI processing a lot better.
And bigger, much bigger chips. We're talking about their chip is 56 times larger than the largest GPU right now, which is, I guess, an NVIDIA chip type thing.
Yeah, imagine if Microsoft was we're going to make an iPhone, we're going to make a phone that's 56 times more powerful than your stupid iPhone.
Yeah.
It's a pretty big deal. Bigger would be a problem, right? Physically, we wouldn't want that.
56 times larger. It's as big as an apartment building. But
it's we're coming full circle. We're going back to the computers in the 70s that took up a whole room. I love this. This is a good sign. AI is very exciting. Some analysts think AI is a bubble and they think it's a lot of bloviating, but it seems exciting. To me, this is again, in my small sample size of our 400-ish clients who have had companies go public, file S1s, pull back S1s, be scared to go public for the past couple of years, this type of company filing their S1 to me is a very good sign. Even if they don't actually go public in 2024, which they are probably out of time to do, it's a good sign that we're going to see the IPO market pick back up in 2025 in Q1.
Yeah, and I think, we have seen this bit of AI washing, I would say. A lot of everybody's trying to say they're AI. I think this company's saying, hey, we make chips and compete with NVIDIA. That's a very compelling case to say, hey, no, we really are an AI we are an AI adjacent industry. There's not a lot of competition for NVIDIA right now. They've got their wafer scale engine chip, they call it. It's much larger. Apparently, they're really trying to take some market share away from NVIDIA, which really has dominated this space.
Yeah.
And so competition is a good thing in a capitalist economy. So
totally.
Pretty interesting to see what happens there. And does that, right, as you were saying, kind of forebode a bunch of other AI adjacent IPOs or something like that, or IPOs in general?
Yeah, or just IPOs bolstered by innovations in AI. Before we get to a listener question, anything else you want to say about Q3? Any final thoughts? How do we do? Rate this quarter. Give it a grade.
Final thoughts on Q3. Here's what you need to keep in mind. You have a diversified portfolio, so you participated in the gains. If you don't have a diversified portfolio, if you just own some tech names, you're a big fat loser. Do as well in Q3. So diversification is the name of the game in Q3. As we head into Q4, it's saying, hey, there's an election going on. There are a lot of scary headlines, right? Fear sells. At the end of the day, your portfolio is a long-term portfolio. It's designed to hold up regardless of who's in power, regardless of what happens, right? And so we are going to stay the course. We're going to stay invested throughout that, and we're going to manage the emotions, everything that comes with the uncertainty of an election so that we don't make any rash decisions. That's the name of the game for Q4.
Yeah, also,
Buckle up.
we'll talk about this on a future podcast. And I think we're going to do a webinar about tax planning changes based on the results of the election.
Yes.
You can look at any chart and it'll tell you how, like, does the economy do better in a Republican or Democratic presidency? And the results are so mixed and varies that there's literally no trend. So I don't want to hear anyone say, well, if so-and-so gets elected, the economy is going to fall apart. There's no trend to follow. I think it's actually going to be a good thing. I think we're going to have some certainty, which will allow companies to prepare for the next 4 years of legislation. We have a lot of tax policy on the line, so that'll be interesting.
That's the big one.
The rich will get richer. We will likely pay less taxes no matter who's in power. So life is good.
There's a lot of proposals out there on the tax front that are very interesting, none of which really involve raising taxes on most people.
On anyone, yeah, exactly.
So that's been fun. But yes, stay tuned. If you have questions about this election stuff, on how it impacts your portfolio of markets, reach out. We're here. We're here to talk about it.
Yeah, we are. Yep. Okay, listener question.
Yeah.
You want to read
This
it
is
to
from
us,
Reddit.
Tom?
Shane
I forgot how
grabbed
to
this
read.
from Reddit.
I'm too tired.
You want me to read it?
Yeah.
Am I crazy to buy a $1+ million house in cash? No extreme financial independence, retire early goals here, but a guaranteed 7% ROI by paying cash is really appealing to me. I know I can likely make more in the market, but it would give me a lot of peace of mind and keep my minimum monthly payments to just taxes and utilities. I'm also not certain about how to factor on mortgage amortization schedule in my ROI calculation, which is probably why it's wrong. But it has to be higher than the loan rate, I imagine. Any thoughts here? Anyone have a similar boat? So you got the money. It's $1 million house. You can just pay cash for it. Then you don't need to get a mortgage. AJ, I've never had a mortgage. Why don't we start off with your take? You've had a couple of them.
I don't like this. I love to borrow money. I think borrowing money is the greatest way to generate wealth and opportunity in history.
Leverage.
You get to borrow money and you get to keep a lot of the money in your pocket or doing other things, right? We talked about diversification. If I had $1 million liquid to buy $1 million house, I would not do that. The bank wouldn't want me to do that. The bank would want to loan me money. Yes, borrowing money is quote unquote expensive. This person is using, I think they're assuming a 7% mortgage interest rate, which is sure. Let's say you have a medium to shitty credit score, you can probably expect to get a 7% interest rate on your mortgage right now. Something we have talked a lot about, you and I, John, in our rent versus buy webinars, is the terms of mortgages. Typically, a mortgage is a 30-year term, sometimes 15%, but usually 30. But the statistics show us, and this is not a survey, this is actual statistics of banks reporting facts and figures, that the average length of a mortgage, aka how long a person is in their house before they sell it, is 7 years, not 30 years, right? So you're basically tying up all this cash for literally no reason to then have an exit at the end. It just doesn't make any sense to me. Concentration risk is a huge red flag here for me. Also, I think we should acknowledge that there's a horrible tragedy happening right now. We have Hurricane Helene ripping through the American Southeast. Yeah. And yes, of course, we can have homeowners insurance, but try getting hurricane insurance in the Southeast right now. There are companies that are no longer offering it. Like, you put $1 million in that house, sure, it's still your house, you still own it, you're still on the hook with the bank, but you have a partner there. You didn't spend $1 million of your own cash. You probably spent $200,000. We're hearing horror stories of people losing everything and not getting those insurance payments. And by the way, if you do get those insurance payments, it's not like it shows up in your bank account next week. Like, these are long battles that go out. They often go to court. So sorry, that was a little bit of a rant, but this is a big no-no for me.
Yeah, and I think, let's take a step back. So somebody who has $1 million in cash sounds like a bank account that they can use to buy a house.
I bet it's not. I bet it's in the market, and I bet
in the market, or it's probably not in a retirement account, hopefully, because otherwise we need to factor in taxes if you're going to get it out. But in this hypothetical, if you have that, first of all, I think we need to ask the question: how much of this is $1 million is what percentage of your net worth? That's what I'm trying to say, right? If $1 million is 50% of your net worth and you're just going to throw it in your house, then that's a very risky thing to do. If $1 million is 1% of your net worth because you have $100 million, then why are you getting advice on Reddit? You could probably pay a professional. Because you got
nothing else to do.
Answer this question for you, and it's also at that point, if you want to spend 1% of your net worth on a house and have 100% equity, who cares, right? I'm guessing this person's somewhere in between. They're probably not worth $2 million. They're probably not worth $100 million. But I think the ROI, I think we need to understand the opportunity cost of the ROI. Even if you kept the money in cash and put it in 30-year treasuries, you'd get 4% or something like that for it right now versus it sounds like mortgage rates right now are at about 6%. And so your real kind of your delta there, your difference is about 2%. Okay. Yeah. And so then the question becomes, well, the home should appreciate over time. It'll appreciate whether you have a mortgage on it or not. But you're tying up a lot of capital in an illiquid asset.
And don't forget about the mortgage interest deduction, which is still pretty significant.
And on $1 million home, you're going to be able to write off about 75% of that interest. If you're buying $1 million home, you're actually going to put 20% down. And so you'll be able to write off probably close to 90% of the interest because that's capped at $750,000 in mortgage debt that you can write off the interest for. So I do think that my thought would be, in the current rate environment, it doesn't make sense. If you have the $1 million, if you have the assets, right, and you get sick of paying this mortgage someday, you're concerned about that, you can maintain the optionality to pay it off later.
Pay it off whenever you want, yeah.
Right? But if your income goes away and you just have all this equity tied up in this home, then a bank might not lend to you against that equity to borrow, or might limit how much you can borrow against it, and then you might be
just refuse outright. Remember, people think of HELOCs as this I can always tap my HELOC.
Yeah,
you got to show up to the bank with a paycheck showing that you have the ability to pay that back. So let's remember that when you are putting that much concentrated risk into one asset, there are obviously ways to get out of it and borrow against it and whatever. You can always do a reverse mortgage and go back into the house and tap the equity. But we all know, it's hard when you have the opportunity if you have the opportunity to get a mortgage, meaning you have steady income that you can show a bank.
Yeah.
Why wouldn't you do that? And I get it. Interest rates feel high and you feel like there's this opportunity for arbitrage. Yeah. But if you have the tolerance for risk and you have a little bit of an appetite for risk and you're excited about growth, keep some of that money in the stock market.
And I think the other thing, AJ, that I would just meant a final thought on this is, if somebody came to me as a client with this question and was adamant about putting more down, what I would do is I would start my negotiation with them and say, okay, instead of 100% equity, all that, what if we put a little bit more down than usual? Instead of 20, we did 40. What if we did that? And then we can still always pay off the whole thing. There's typically not a penalty for prepaying your mortgage, that sort of thing, for doing that. And but negotiate. That's my thought. Let's find a compromise. Let's maintain optionality, and then decide. We don't need to figure this out. We don't need to decide the next 30 years right now. We just need to make a decision right now for how we have some flexibility for the unknowns.
For sure. I actually read a few of the comments, and some of the comments were like, personally, I like owning my residence outright. Personally, this gives me security. Yeah. Personally, I don't like owing the bank money, which okay, fine. And like you said, and actually someone asked this question in the webinar, which I thought was really smart, which is as your net worth grows, does the rent versus buy calculus change a little bit? To your point, John, if $1 million is 10% of your net worth, buy it with cash. I don't give a shit. Yeah. That matters less to me. But to me, this is not a you're an idiot if you do this kind of question. This is I wouldn't do this. I would not put all of your money.
I would not do it, and it's likely an inefficient financial decision that you are making for peace of mind. Now, we all make inefficient financial decisions every single day, and that they don't necessarily blow up our personal financial plan, right? If you spend $200 on laundry detergent, you're probably making an inefficient financial decision.
Actually, it is efficient because I'm saving money on the Uber when I'm trying to lug that shit back from Target, and I get tired that I end up taking an $18 surge Uber, so I'm actually saving at least 10%.
It's basically paying for your laundry to be done.
I'm being paid. Yes, exactly.
Just getting paid to do our own laundry in this scenario.
Actually, in the division of labor in my household, I have two jobs. One is I make the coffee in the morning, and the other is I do the laundry. So laundry is very important to me and in my household.
Making sure, that's key. That's good. I'm glad to hear there is a nice division of.
Yeah, Nabil does everything else.
I was super okay, maybe it's not that nice of a division of labor in hindsight.
And we love him for it. Okay, so
awesome.
That's all I have to say on this. Happy Q4, ladies and gentlemen. We will see you next week on the Liquidity Event. Thank you. You've been a wonderful audience. You can always find us on Liquidity Event. Where are we?
You can. All right, thank you for listening, folks. Email us your financial questions at liquidityevent@brooklynfi.com. Leave us a voicemail at memo.fm/theliquidity and we'll play it on the air. And finally, Stans, leave us a review if you want to be weird about it. Filling in for Shane Mason, I'm John Owens. She's AJ Ayers. Thanks for coming along for the ride.
Thank you for helping me remember my own name. See you next week, folks. Bye.